Welcome to your ultimate guide to the VA home loan benefit. In this video, we will explain how zero down and zero PMI can make homeownership more accessible, while also covering the funding fee, the appraisal process, and common pitfalls to avoid. We will move step by step, starting with what a VA loan actually is, and then transitioning into the advantages, trade-offs, process, and pro tips from the field. By the end, you will know how to confidently use this powerful benefit responsibly. Here is the agenda for today. First, we will define the VA loan and how it works. Next, we will review the key advantages, including zero down and no PMI. Then, we will discuss the VA funding fee, including best practices on paying it. After that, we will walk through the loan process and the VA appraisal. We will then address risks, myths, and practical tips. Finally, we will test your understanding with short quizzes and wrap up with an action checklist. A VA loan is not a pot of government money handed to you. Instead, it is a federal guarantee that reduces the lender's risk. Because the Department of Veterans Affairs guarantees a portion of the loan, private lenders can offer better terms. Consequently, eligible veterans, service members, and some surviving spouses can secure mortgages with more flexible underwriting, often at lower rates, and without private mortgage insurance. This guarantee is the engine that makes the benefit so valuable. Let us start with the major strengths. First, 0% down payment means you can conserve cash for closing costs, repairs, or an emergency fund. Second, no private mortgage insurance removes a monthly cost that is common on conventional loans with less than 20% down. Third, the VA guarantee often leads to competitive interest rates. Fourth, many lenders can be more flexible with debt-to-income ratios on VA loans than on civilian loan programs, within reason. Fifth, the VA benefit can be reusable under certain criteria, and some VA loans can be assumed by qualified buyers, which may help you when selling in certain markets. This flowchart shows the typical VA loan journey. First, you verify eligibility. If eligible, you obtain your certificate of eligibility. Next, you get pre-approved with a lender experienced in VA loans. Then, you shop for a home and include the VA addendum in your offer. After mutual acceptance, a VA appraisal is ordered, which also checks minimum property requirements. If the appraisal or MPRs reveal issues, you address them through repairs or negotiation. Otherwise, the file moves to underwriting. Once underwriting conditions are satisfied, you receive a clear to close. Finally, you sign closing documents, the loan funds, and you receive your keys. To begin, confirm your eligibility and request your certificate of eligibility via the VA portal. Next, interview a few lenders who frequently close VA loans. Then, obtain a strong pre-approval letter before you start shopping. Select a real estate agent who regularly handles VA transactions. When submitting offers, include the VA addendum and realistic timelines to accommodate appraisal and underwriting. Prepare your documentation early, including income, service, and asset verification. Finally, budget for closing costs and, if possible, plan to pay the funding fee at closing. Here are the headline advantages. 1. You can purchase with 0% down. 2. There is no private mortgage insurance on VA purchase loans. 3. Thanks to the guarantee, lenders frequently offer competitive interest rates. 4. Qualification standards regarding debt and income can be more forgiving than many conventional programs. 5. The benefit can sometimes be reused, and certain VA loans may be assumable by a qualified buyer, which can be valuable in a higher rate environment. This table summarizes common VA funding fee rates in recent years for purchase and streamlined refinance scenarios. 0% down on a first use typically carries a 2.15% fee, while subsequent use with zero down is 3.3%. With 5 to 9.99% down, the fee is often 1.5% for both first and subsequent use. With 10% or more down, it is commonly 1.25%. The interest rate reduction refinance loan typically has a 0.5% fee. Borrowers with qualifying service-connected disability are generally exempt. Exact fees can change by law, date, and loan purpose, so confirm the current schedule with your lender and VA before committing. Comparing VA and conventional loans helps clarify the trade-offs. The VA loan enables zero down, eliminates PMI, and can offer competitive rates. However, a funding fee generally applies unless exempt, and the appraisal must meet VA minimum property requirements. Conventional loans can work well for borrowers with significant down payments and strong credit. They do not require a VA funding fee. If you put less than 20% down on a conventional loan, PMI applies, but can be canceled later as equity builds. Your best option depends on your cash, credit, timeline, and plans for the property. There are important cautions. First, the VA funding fee is a one-time cost. Many experts advise paying it at closing rather than financing it to avoid starting the loan underwater. Second, the VA appraisal includes minimum property requirements, so plan for additional time and choose professionals who know the process. Third, in rare cases of default or short sale, the federal guarantee can lead to recovery efforts by the government, so treat this benefit with care. Finally, some sellers or agents may be unfamiliar with VA specifics, so assemble a team experienced in VA transactions. This pie chart illustrates a typical monthly payment composition. Principal and interest often make up the largest share. Property taxes and homeowners insurance are common components as well. Homeowner association or condo fees may apply depending on the property. Notably, PMI is shown as 0 for VA purchases, reflecting one of the key savings of this benefit. A practical strategy is to pay the funding fee at closing when possible. Doing so helps you avoid negative equity on day one and reduces the compounded interest you would pay if the fee is financed. For example, on a $400,000 purchase at 0 down, a 2.15% fee is $8,600. Adding it to the loan increases your loan balance and lifetime interest. If cash is tight, discuss seller or lender credits to offset other closing costs while you pay the fee up front. Always verify current fees, exemptions, and calculations with your lender and the VA. Quiz time. Question: which VA loan advantage most directly lowers your monthly payment compared to a similar conventional loan with less than 20% down? Options: 0 down payment, no private mortgage insurance, favorable interest rates, flexible debt-to-income ratios. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is no private mortgage insurance. While 0 down is a cash advantage at closing and favorable rates can help, eliminating PMI is the most direct and consistent monthly payment saver compared to a conventional loan with less than 20% down. Second quiz. Question: what is the recommended approach to the VA funding fee if you have the cash available? Options: roll it into the loan to keep cash on hand. Pay it at closing to avoid starting underwater. Skip it. No one checks. Ask the seller to pay PMI instead. You may pause the video now to consider your answer. We will cover the correct answer in the next section. The correct answer is to pay the funding fee at closing to avoid starting with negative equity and to reduce interest costs over time. If cash is tight, discuss credits to offset other closing costs while keeping the funding fee off the loan balance. VA appraisals serve two purposes. They verify the property's value, and they confirm the home meets minimum property requirements for safety, soundness, and sanitation. Build enough time into your contract for potential repairs or re-inspections. Work with professionals who understand VA expectations to prevent delays and ensure a smooth closing. This timeline highlights 4 phases. During pre-approval, you organize documents and obtain your certificate of eligibility. In the house hunting phase, you tour homes and sign an accepted offer. During appraisal and underwriting, the VA appraisal is completed and any conditions are cleared. Finally, at closing, you conduct a final walkthrough, sign closing documents, and receive your keys. Choose a lender with extensive VA experience because process familiarity reduces friction. Select a real estate agent who understands VA addenda and MPRs. Work with a title or escrow company that is comfortable with VA timelines and fee structures. Finally, hire a thorough home inspector who can identify safety items that could trigger MPR repairs so you are not surprised later. Let us walk through sample numbers. On a $400,000 purchase with a first-use funding fee of 2.15% and 0 down, the fee is $8,600. If you finance the fee, your starting loan balance becomes approximately $408,600 instead of $400,000. Because there is no PMI on VA purchases, Monthly savings compared to a conventional loan could range from roughly $150 to $350 or more, depending on credit and loan to value. As a best practice, maintain an emergency fund of at least 3 to 6 months of expenses before closing. These numbers are illustrative only. Verify actual costs with your lender. The federal guarantee enables better loan terms, yet your repayment obligations remain significant. In rare but serious hardship scenarios, short sales or defaults can lead to debt recovery actions. If you experience financial distress, contact your loan servicer and explore VA resources early to avoid escalation. Plan for long-term affordability and use this benefit responsibly. This content is for educational purposes only and does not constitute legal, tax, or financial advice. Always verify your eligibility, funding fee rates, and loan terms with the Department of Veterans Affairs and your chosen lender. Policies, rates, and fees can change, so confirm current details before making decisions. We are not affiliated with the VA, the Department of Defense, or any government agency. To wrap up, confirm your eligibility and secure your certificate of eligibility. Interview lenders and agents with strong VA experience. Leverage zero down and no PMI, but run the numbers. If possible, plan to pay the funding fee at closing. Budget enough time for the VA appraisal and MPR requirements. Finally, maintain healthy reserves and a long-term plan for ownership. Thank you for watching. If this video helped you understand the VA loan benefit, please like the video, share it with a fellow veteran or service member, and subscribe for more guides. Finally, leave your questions and experiences in the comments. Your story could help someone else succeed.